And now that we've heard about some very specific kinds of investments, we're going to go back to something a little broader and the value of diversification with Peter Muldowney and of Connor Clark and Lund Financial Group and Anish Chopra.
That's right. He's coming up later.
He's coming up.
He's here, don't worry.
Okay.
All right.
Well, I'm going to leave you on stage too.
Thanks.
Thank you.
So good afternoon, everyone. So it was Harry Markowitz, who is obviously the creator of modern portfolio theory, that is credited with the quote, "Diversification is the only free lunch in investing." You'll see that my plate on the slide is empty. So this afternoon, the goal is to provide some food for thought for when you next review your investments by highlighting the value of diversification. Now, while I've called Canada home for over 20 years, I actually grew up in the northeast of England. However, it's not the best place to grow up. But anyway, what is nice and what we did during the school holidays was visit Cornwall, which is shown here. It's absolutely beautiful beach city, and it took about 10 hours by train from the northeast of England to get there. It's on the very tip of the south coast of England. We stayed with my Aunt Susie, who lived pretty close to the beach, and she actually had a small shop. Now, at first, in that shop, all she sold was sunscreen. Now, if you were paying attention, I did say England. Not famous for its dry, wonderful summers. It rained a lot too, a bit like what we're experiencing today. And in those rainy days, nobody would come to the shop. So what she did is she also started to sell umbrellas, which then improved the income on those rainy days. The challenge is she didn't get any repeat customers, because once you've bought your tube of sunscreen or an umbrella, it's not like you have to come back for a second umbrella. So to attract repeat customers, she started to sell ice cream and cold drinks, which was great on those hot sunny days, but on rainy days, we generally don't really like ice cream. So to attract income on the rainy days, she started to sell hot drinks and muffins, improving that income whether it was raining or it was sunny. Now also, when we're on vacation, we like to buy souvenirs to bring back for other family members who perhaps weren't there. So the final addition was to create a little small area in the shop to sell t-shirts and other souvenirs. And that provided my first introduction to the value of diversification. So in the balance of the presentation, we're going to explore the different dimensions of diversification and specifically how they apply to investing to contribute to more efficient portfolios. And then Anish Chopra is going to join me on stage. He's been a member of the investment committee of the Lawson Foundation for a pretty long time, and he's going to share with you how they explored the different potential diversifying assets. So the 4 dimensions of diversification we'll discuss are shown here, starting with market or portfolio breadth, which is the metric used to gauge how strong a particular market is in terms of being able to deliver consistent returns. The second dimension will examine the differences in the risk and return characteristics of the various asset classes, and it's related to the third, which is how you can benefit from investments that behave differently such that when you combine them in a portfolio, they contribute to superior risk and superior risk-adjusted returns. And then the fourth dimension captures the unique characteristics of alternative investments. Now, if we look back over the last decade or 2 decades, the conversation regarding market breadth was very much focused on the challenges of the Canadian equity market, where the top 15 stocks represented about 47% of the index. Now, in response, investors gradually increased their allocation to global equities and reduced their allocation to Canadian equities. Yet when we move the clock forward to the present day, we're facing a very similar dilemma, but this time with regards to the reduced breadth of the US equity market and to a lesser extent, global equities. So the media attention has very much been focused on the Magnificent Seven, the small number of companies, including Apple, Amazon, NVIDIA, that have been driving the US equity markets higher due to the investor exuberance regarding the potential merits of artificial intelligence. Now, you can see over the last decade, the market capitalization of these stocks has grown so significantly. At the end of December 24, they represented over 33% of the index. Now, if you each looked at your own endowment and foundation portfolio, you might find the US equity is either the largest individual component or pretty close to the largest. So with this increased concentration in US equity market, portfolio risk management through improving your diversification is key. Now, what I'm not saying is that the US technology sector can't continue to perform well, but if you just look at the chart, those 7 stocks at the end of 2021 represented 27% of the index, but by the end of 22 had fallen to 20%, just serving as a reminder that there are less favorable environments where technology stocks can underperform quite significantly. Now, if we were to look to improve diversification just within equities, for me, what stands out is the global small cap market, at least from a breadth perspective. The MSCI World Small Cap Index covers 23 countries, and most importantly, the largest stock in that index represents 0.2% of the index. That compares to RBC being 6.9% of the TSX, or Apple 7.6% of the S&P 500. Even when we combine the largest 15 stocks in the Global Small Cap Index, they're less than 3%, whereas the largest 15 stocks in the S&P 500, when you throw in the other 8, is 45%. Also, don't be put off by the small cap. There's over 2,700 companies with a market capitalization of over $1 billion US, and that compares to just over 200 in the TSX. Now, small cap equities, global small cap might provide some diversification benefits within equities, but of course, there are a lot more asset classes that you can tap into to improve portfolio diversification. The challenge, there's just so much to choose from. And sometimes it'll make your head spin when you're thrown all these different investment options. The good news is we can actually place all of these different investments into one of 2 broad investment types. Specifically, those investments that you provide a loan to and those that you own part of it. And the characteristics of a loan versus owning are fundamentally different. So for example, lenders provide funds to companies to help operate a business or perhaps even purchase a new business. In exchange, those borrowers make regular interest payments and then pay back the full loan at the end of an agreed-upon period, could be in 5 years. It's a contractual agreement where, assuming those interest payments and the loan amount is paid as agreed, then the return is actually known in advance. Contrast that to when you own an investment, such as equity shares in a company, you're entitled to your proportional share of that investment. But unlike fixed income, there's no return guarantee. But with the greater uncertainty, there's often an expectation, but no guarantee that you'll earn a higher reward. So to try to put some sort of color and illustrate the different risk and return profiles, we'll take a look at the range of returns over the last 44 calendar years for fixed income and global equities. So we'll start with fixed income as an example of the loan illustration. So I'm going to add all these different green blocks on a chart, and you'll see across the horizontal axes, there's these little return buckets. And the idea is we're going to drop each of the yearly returns into the appropriate bucket and create a return distribution. This is the very bottom row, so you can see that the range of returns were from minus 11.7 all the way up to plus 35. So when we build up the different observations, you see the majority of the green blocks are in that 0 to 16%, with an average return of 8, which is represented by that middle point of the distribution curve. So now when we look at the ownership example, the first thing you'll notice, it's much wider distribution. And to compensate for that greater risk of the ownership, the equities, the average return was higher at 12%. Easier to see when we put the two together. You see that taller distribution for fixed income just means there's less risk, with more returns in a much narrower range. But you can also see the actual average return was lower. While equities offers the prospect of higher returns, it also has the risk of more negative and larger negative returns. So coming back now to the third dimension, which is when diversification comes into play. By benefiting from the fact that these two different asset classes behave differently, when combined in a portfolio, we can get these superior risk-adjusted returns. Even using a really simple example of 60% equities, 40% fixed income, we can observe the value of diversification, which again is much simpler when we add it all on one chart. So first off, you'll see that the return was in between equities and fixed income, but importantly, we gave up some of the upside from equities, but we got rid of some of the downside. So using diversification, we were able to earn superior risk-adjusted returns. Now, when it comes to diversification, the benefits can be even greater when we also include alternative investments. But of course, they're not without their own challenges, which leads to the final dimension, which is the unique liquidity and valuation characteristics associated with alternative investments. Investments such as commercial real estate, infrastructure, private equity, private credit, they are all less liquid assets, and as such, their valuations occur less frequently. But this actually contributes to lower correlations with traditional investments and provides some really powerful portfolio diversification benefits. Now, according to PwC, the total assets under management is going to reach $145 trillion US dollars in 2025, of which alternative investments will comprise almost 15% of that, so 21 trillion. Now, due to the unique characteristics of alternative investments, traditional risk measures that are typically used when we're analyzing the benefits of equities versus fixed income don't appropriately capture their risk and return relationship. Therefore, whenever you're analyzing the potential introduction of alternatives, you need to be really careful assessing what contribution you're actually going to get from those alternatives. And ideally, I always recommend that you reflect the expectations of the actual specific strategy that's being considered. So, while diversification might be the only free lunch in investing, it's important to appreciate the different dimensions that make up diversification. So with that rapid sort of little overview, I'm going to invite Anish to join me on stage, and he's going to be the dessert component of our food for thought. I hope he doesn't mind that reference. So no one's fallen off yet, so no. Don't be the first.
You never know.
You never know. So let's kick things off, but tell us a little bit about the Lawson Foundation as well as how long you have actually been on the investment committee.
Sure. So I've been on the investment committee for over 10 years, so quite a long time, and you get the chance to see a lot of different things. That was the short question. So the longer question is, what does the Lawson Foundation do? What's the mission? The Lawson Foundation focuses on the development of youth and children. So, for example, early development for children and youth. We work in the Indigenous community, once again focusing on the development of children and youth. Stuff like outdoor play, how the environment affects youth. So that's sort of our mission. So it's around just the healthy development of kids and the young members of our society.
Great. In terms of the assets under management, how much money is the foundation?
So the foundation has like the AUM, or assets under management, is about 150 million. Invested across a variety of different asset classes.
So it talked about equities, fixed, alternatives. How would you sort of estimate those three buckets in terms of how you're invested?
Right, so when we look at it, we've got 150 million in AUM, and we manage the money in ranges. So it's 60 to 70% is in equities, and 30 to 40% is in fixed income. And the alternatives for us are considered in the equity bucket.
Okay, great. Now, we're talking about looking at diversification. How would you describe is the philosophy of the committee when it comes to investing?
Right, so the overarching goal is just to make sure that we can achieve the mission of the organization and make sure we have sufficient distributions to cover the various areas that we support. But when we look at how we invest money, it's really diversification is very, very important to us. So we want as many different return streams that aren't correlated that we can find to help us out. Now, it works until it doesn't, right? So we can have lots of different diversified income streams. You can say fixed income is different than equities, okay? But the problem is there's certain periods like COVID where everything goes wrong, right? So you take a hit on the equities portfolio, something happens in the corporate bond market, so lots of different things are playing out. So absent that, we still want diversification, and sometimes, let's say in the great financial crisis, having a high quality government bond portfolio did offset the issues in equities that took place.
So let's break down each of those categories. So we'll start with equities. How diversified are you within equities? Because I think you don't look like the norm, shall we say?
Right. As we talked about earlier, we want to be as diversified as we can be. So we're in Canadian equities, global large cap, global small cap, as well as in emerging markets.
So that's been a fun journey for you.
Yeah. And there's always ups and downs. There's always some excitement in one of the different areas we're invested in.
Now, we went through some interesting times with fixed income, and obviously 2022 was ugly with that minus 11.7% return that I referred to was 2022. But you did some interesting things in your fixed income sort of area. Would you like to talk a little bit about what you've been doing?
Sure. So I've been on the committee for 10 years, and if you look at from the great financial crisis, probably right into the early 2020s, we've had a very, very low rate environment. So we've, at the Lawson Foundation on the investment committee, we've really tried to find ways to increase the yield on our portfolio. And it certainly was a struggle, right? Like we don't want to take on a lot of risk. So where do we find things? Well, during the COVID period, there were some areas that had some types of dislocations. Certainly government bonds, the yields fell, but other areas, they actually rose. Corporate bonds would be one. But one area that we found interesting for us, and we could build a portfolio around it, was preferred shares. So we were in the Canadian preferred share market. So in the preferred share market in Canada, it's not a big market, right? It's not the US Treasury market where everybody participates. So we were able to get higher yields, and part of the reason for the higher yield was the fact that it's less liquid. So we were taking advantage of the fact that that market was less liquid during the early to mid part of COVID, generating higher yields. And then over time, what's happened is the yields have fallen as the areas become more liquid again. So we took advantage of higher yields and low liquidity by being the liquidity provider. And then when you sit back and think of the mandate of the Lawson Foundation, right? Like we also put an ESG lens on things, and we've been looking at another area, green bonds, and we're looking at this, but for a while, just to give an example, let's say you had a Government of Canada 10-year bond, it would be yielding 3%, but if you wanted the equivalent 10-year green bond, you were getting 2.8%, right? So it's like, do we really want to give that 20 basis points up? But now if you look at it, that the give up in yield, they're essentially trading at the same yield. So once again, we're just able to take advantage of it. It's just when the green bonds first came out, there's a newness to it, right? So people are willing to bid the price up and take a slightly less yield. But as the areas mature, pricing changes. So those were the two things that we did in fixed income during, let's say, from 2020 onward. So pref shares was one, and green bonds was the other.
Great. So alternatives, I've talked about there's been a lot of money moving into alternatives, but what I thought would be really interesting for folks to hear is not just what you decided to invest in, but what you looked at but chose not to invest in, and just some of the reasons why. Obviously, everyone has different choices and everything, but it's sometimes good to hear what you don't invest in versus always hearing about we went into this.
For sure. So one of the things at the Lawson Foundation, we try to manage the amount of alternatives that we have. So we do impact investing as well. So when we look at both an alternatives area and the impact side, we've got just a bigger pool of funds that's illiquid. So when we look at alternatives, we want to make sure the sizing's right as well as the areas we go in are right. So in the, I think this was the early 2020s, we looked at a few areas. One was commercial real estate, and we took a pass on that just because of economic sensitivity. And you can see that today, right? Like the aftermath of COVID, and then if you get some type of recession, like office rents and whatnot, office vacancy rises, office rents fall. So we stayed out of commercial real estate. So that was, I guess, part analysis and part luck on timing. That's one. We also looked at farmland, but it wasn't the right fit for the committee at the time we were looking at it. So this is 3-4 years ago. The one area that we decided to invest in was infrastructure, right? And so for us, infrastructure met a lot of the different goals that met the mission of the foundation, right? So when you look at put on infrastructure through an ESG lens, it's green energy. You've got rebuilding of bridges and new toll roads, stuff like that. So we could, once again, when you look at it, it meets the mission of the foundation because there's an ESG component to it. It's diversified, so diversified by, let's say, infrastructure asset class. So that could be whether we're looking at roads or bridges or energy projects. And then we could also get diversification by geography, right? So we're just trying to be as diversified and as thoughtful as we can.
Great. You mentioned impact. You're also on the impact committee. Could you share about how that journey's been and how different it might be today from when you first started down that path?
Yeah, for sure. So Lawson started in the impact area in 2014, so about 11 years ago. And it was an interesting field then, and the investment committee, there wasn't a lot in the investing community, like experienced individuals in impact to go and speak with. So in some ways we were, we were one of the first in the area, and there was a lot of learning to do. So in the early days, it was very hard to find impact investing projects that we wanted to be in, and we were probably broader than what our far more narrow mission is, just in order to get into the impact area, because there weren't the number of projects. The other issue that we had was due diligence, right? So we had to hire lawyers, and then over time, other foundations came on board. You could split the legal costs and the due diligence costs. So that's, let's say, 2014 to 5 years in, let's say up to 2019. But the the impact area has matured a lot. So now you have funds that are focused, let's say, on climate, or funds that are focused on healthcare outcomes. So it's a lot easier for us to find things that meet our mission, that are diversified, because now you invest in funds as opposed to individual projects. So it's really matured as an area for us to invest in, especially since we started in the early days where you'd just be vetting like one project, right? Okay, what size can you do in this one project? And you tend to go smaller, but it took the same amount of due diligence and legal costs as a bigger project. But at least once you get into funds, the funds themselves tend to be very diversified across, let's say it's a climate fund, different projects, different geographies. So it's just, I think, an easier world for us to invest in on the impact side than it was a decade ago.
Great. Questions? Give everyone the opportunity to ask a question. Anyone out there has a question? Got a hand up over there?
I have a question. I sit on the board of directors for a nonprofit affordable housing unit, and we're about to launch a $50 million community bond offering. And I'm wondering how attractive something like that is to a foundation like yours in terms of impact investing.
We've looked at that, and some of the foundations that we work with have looked at those kind of projects. So affordable housing is certainly something that we would look at. Depends on the conditions and the terms and stuff like that. But from a top level view, it's something we would look at for sure.
I think you should expect a call.
Hi there, my name is Gerard Feliciano from Capstone Asset Management. If there was one thing that you would wish for in terms of a kind of impact fund that you would be really interested in, what would that be if you had, a wish list?
One that met exactly the goals of the foundation, right?
Which is?
We're focused on children and youth, outdoor play, child development, indigenous communities and their youth. But we're sort of broad. So the other thing would be if somebody, if the impact fund was, let's say, indigenous communities youth, right? So that the fund was just specialized in one thing. It'd be great if all of the things were in one, but I don't think we can expect that. But if you had a fund that just focused on indigenous youth, that's something we would certainly look at. If there's one just focused on outdoor play, we would certainly look at that. We do look at a variety of different areas and try to, there's still nothing that fits exactly down the mission, but if it can, that would be fantastic.
I thought for a minute he was going to say he's got one. Any other questions? Yep, one back.
Hi there. I'm with the Kensington Market Community Land Trust, and we've also launched a community bond. So I was curious in terms of from a foundation side, is it more likely to invest in a community bond when it's not tied to a certain asset yet, and it's more for we are raising money, we're going to acquire a property? Or is it better for us to have an asset held? That way you can know what the liabilities are. You can have all the due diligence on it before you would maybe invest into it. Yeah,
that's a good question. I guess I chair the Impact Investing Committee now, but so I'm sure different members of the committee would have different views. But to me, it's easier to get your mind wrapped around something that's already there, like even if there was a mission around it. So let's say you wanted to work in Northern Ontario, Indigenous communities around housing. At least we understand what you're doing and what you're trying to do there. But if you actually, had a plot of land and whatever, that's a lot easier because we can get the numbers and stuff like that around it and get more comfort.
Yeah, because for us, we're kind of exploring the idea of we could raise money first and then buy the land, or we could seek out a land, get a mortgage or a term for 1 year, and in that term, then transfer that into community bonds, right? That way, if foundations are more comfortable with knowing the whole, the specific property, it might be a better route. So I think
when you think about that, it probably depends on the risks the foundation's willing to take, right? So there'll be some foundations that just want to stay on the lower risk side, on the impact side, and there'll be others that are willing to take a higher level of risk. So you just have to seek out the appropriate party. I prefer like more certainty rather than less, but it depends on who the investor is and who you're looking to go to.
Thank you.
Our time is up, so we want to make time for everyone else. So thank you very much. Anish, really appreciate you.
Thank you, Peter.